Hi guys, welcome to this episode of Opening Bell. I'm Nandita Khemka, and markets have opened in tandem with global cues. In fact, if you look at the global indices, all of them were trading in the green when it comes to Asian indices. In fact, European markets also giving out strong cues, 2-year highs, and Wall Street as well ended higher. So in tandem with that, the Nifty in fact has opened somewhere around 21,450 mark, above that level. Of course, the GIFT Nifty was hinting at a start above that 21,600 mark. But we'll have to see whether or not we gain momentum going forward during the day. But if you look at the Midcap index, that's up by somewhere around 0.3%. So the benchmarks are outperforming the Midcap indices at the current juncture. If you look at the Nifty Bank index, good 1% kind, almost a percent kind of gains coming in there. And if you look at some of the other movers, in fact the gainers and losers on the index today, ONGC, that stock is up nearly 3%, given the fact that crude prices have once again topped that $84 per barrel mark on the Brent, on Brent crude, and that is boding well for the likes of ONGC, Reliance Industries. These are some of the gainers. SBI Life, that stock also among the top gainers. HDFC Bank, in fact, RBI has given approval to LIC to increase stake in the bank to somewhere around 9.99%. On the back of that, HDFC Bank is rebounding in trade, somewhere around nearly 2% kind of gains coming in there. Aside of that, you have Sun Pharma, Coal India, SBI. Mind you, the PSU banking major will be reporting numbers this week. SBI has started off on a strong note, 1% kind of gains coming in there. And on the losing end, you have Cipla. Of course, there was news flow over the weekend that Samina Hamid has stepped down as the exec vice chairman of the company. In fact, management has said that this move is mainly to make the company more professionally managed, right? But it is the top loser on the index today, almost 3% kind of a cut coming in. Dr. Reddy is a close second. ITC ahead of numbers, down nearly 1% or thereabouts. You have BPCL also reporting numbers today, mind you. Profits are expected to go down by somewhere around 70%, and stock is of course out of favor ahead of numbers. But let me also bring on board our guest for today. Joining me is Prashant Sawant of Catalyst Wealth. Great to have you on the show, Prashant. Positive opening for the market. But going forward, do you think it has the potential to sustain, given the fact that we've mostly seen the texture of the market change in the second half of the day? Do you think 21,450 kind of levels, that would sustain in today's session at least?
Very good morning and good morning to all the viewers. So if we currently look at the opening, it's strong and aligned to the global peers. But I think 21,500, 21,540 is going to be a major hurdle in terms of Nifty spot. And unless we don't close above that, the texture will continue to be sell on rise, because there are a lot of gaps on the index, and those gaps we may put an attempt to fill them, but every time we reach there, I'm expecting a strong selling on those levels. So I would not be long on the index, but from the downside, from a support perspective, I think 21,300, 350 zone is extremely important on closing basis. As long as we are holding them, we'll continue to be in this sideways consolidation mode, and unless we don't break out about 21,550, 600 zone in spot, I don't expect a strong up move. But if we do happen to break out, considering we are into the budget week, so if we close about 21,600, 650 spot, I think then we may see a 200, 250 pointer rally to 21,850, 21,900. So for me, considering the week ahead, 21,600, 650 spot happens to be the make or break level, and if we close above that, I'll look out for buying on the index. Unless and until I don't see that, I would avoid the index totally and look. My strategy would be stock specific.
All right, time to be stock specific, but the Nifty Bank index is above that 45,200 mark. Particularly your view on HDFC Bank. We've seen a bounce on the stock today. Do you think one should, actually look at buying the stock on dips now, or do you think it's an avoid at the current juncture, at least for an investment perspective?
So I would consider it to be an avoid zone now. The reason being, there is a big resistance around 1,500 zones. So I would not buy a stock like HDFC Bank for 2-3% gains. It has to be a long-term peak, and it should be, even if it is weak, it should show clear signs of weakness. What's happening now is it is making lower lows on a daily basis, and because of news around, there is some buying around. So I would wait for it to close above 1,500. and only then I would say it is slightly out of the woods. I would look out for buying opportunities. Unless and until the stock does not close above 1500, which is hardly 2.5-3% from the current price level, but that would give me an insurance to go long on HDFC Bank with stop losses placed around 1470, and I would look out for targets around 1560, 1570. So for me, the major level happens to be 1500 closing basis. If we see that, definitely we can go long on HDFC Bank. Till then, I would say avoid.
All right, 1500 is a key level to watch out for on HDFC Bank. Before I bring on board my other guest, want to get your thoughts on an ONGC, that stock very close to 52-week highs, top nifty gainer today. Of course, crude is back around that $84 a barrel mark. So given the setup, would you look at upstream companies now, ONGC, Reliance and the likes, or do you think one should look at the likes of BPCL, HPCL now? Going into, because we had a couple of brokerage notes where the outlook on OMCs was pretty buoyant. So between the upstream and downstream, which one would be a better play now?
I would keep a slightly contra view here. I think there are two. ONGC definitely looks good, but prior to that, I would talk about IOC. I think this looks good from an investment perspective for the next 3 to 4 months. Currently, it's quoting around 144. One can go long, keeping stop losses around 135 spot closing basis from a portfolio perspective. And I'm expecting levels around 155, 160 in the few days to come. And as far as ONGC is concerned, I think it has already shown a lot of strength, and continuously it is quoting around the crucial levels of 230, 235. So I think today's gap up would be slightly worrying for me. So I would wait for it to cool down and go to levels around 235, where I can initiate fresh longs with stop losses around 227 and look out for targets around 250. So just if those who want to buy fresh, wait for a dip around 235, 237 zones.
All right, buy on dips, that's the view on an ONGC. Hold that thought, Prashant. We'll come back and talk about more stocks. But let me also bring on board Vinit Sambre, who's the head Equities DSP Mutual Fund, joining in. Great to have you on the show, Vinit. We are heading into the interim budget. Although, participants say that, this is likely to be a non-event. But what would you really be watching out for, from a market perspective? Would it be the fiscal deficit figure or, the borrowing figure? And, in terms of sector allocations, would defense railways continue to be a focus area? What are your thoughts as we step into interim budget?
Good morning, Nandita, and good morning, viewers, and thank you for having me on the show. So I think clearly, as you mentioned, because this is going to be more like a vote on account, and the main budget is going to be presented in the month of June. I think what essentially that means is that from the vote of account point of perspective, we would clearly be watching for what is the fiscal path which the government would like to really roll out. And that would actually then determine as to what are we looking at in terms of over the next 1 or 2 years as the fiscal deficit number and the government borrowing program. The other important aspect, if you agree to this fact that as far as our economy and growth for most of the companies is concerned, largely over the last 2 years, it has been driven by a lot of the government capex, which has been happening at a good pace across various segments, be it railways, defense, roads to some extent. And I think it is important that the sustainability of those is very critical for these segments to sustain the momentum what we are seeing. Because anyways, given the reforms and the spends which the government has been carrying out, these sectors are trading at rich valuations, and the expectation is that the valuations actually signifies that these type of growth trends need to continue. So hence from that perspective, I think these are the important things to watch out for as far as this budget is concerned.
Right, let's talk about the market as a whole. January seasonality has played out. We've seen the Nifty come off quite a bit, but at times when the markets have run up quite a bit, it's the mid-cap end of the markets that's more vulnerable to sell-off. That's not really happened. So do you expect mid-caps to continue the record run that we've seen, or do you think going forward we could see some bit of correction or meaningful correction coming in there?
So I think, first of all, let us look at the current state of affairs as far as the mid caps and small caps are concerned. On the back of a very strong up move last year, we are already at the high point of the valuations, both on the mid caps and small caps. And when I look at the data over the last 10 years, when I look at the 10-year averages, the mid caps are trading at almost like 20% premium to their 10-year average valuation, and small caps are trading at 25% premium to the 10-year average valuations. Now, one end of the spectrum, we would like to justify the momentum on the back of strong earnings growth, which the category has been showing. The recovery, broad-based recovery, which has been witnessed, is actually leading to most of the companies, benefiting out of this broad-based recovery, and hence to some extent that is justified. But at the other end of the spectrum, I believe that as we enter the next maybe 2 or 3 quarters, there is a likelihood of some deceleration in earnings, which is actually staring us as of now. And that those trends are right now also visible when we look at the current December quarter earnings which are getting rolled out. Most of the consumers category are have slowed down. A lot of the benefits which the corporate India saw because of the lower cost over the last 1 year, those are also waning out. And if you see, the broader top line growth has been decelerating. Plus, the macro picture, the oil prices marginally they have started going up. I don't know where they will settle, but I think some of these risks are also actually coming about. So I think to me, the deceleration in growth is some thing to watch out for over the next 2 or 3 quarters. And if we don't see the momentum sustaining, then I think there is a room for the consolidation maybe, or correction to some extent as far as the mid caps and small caps are concerned. But having said that, let me also in the same breath mention that we are all quite positive over the longer term, and at opportune time or at opportune valuations, we would be looking at investing in some good businesses in the interim as things consolidate over the next 6 months or so.
Right. One last question really. What are your thoughts on the IT space? After the numbers came out, particularly for the large cap IT, the street believes that, the bottom may be in place when it comes to revenues, right? And we've seen the stocks rally quite a bit. What are your thoughts on large cap IT vis-a-vis mid cap IT now? Would you prefer mid caps still after the numbers, or do you think it's time to shift to large caps?
So I think we have a preference for mid caps, given the fact that some of these mid caps are really outperforming their large cap peers in terms of growth and sustainability of the growth. And while I agree that the whole sector is actually going through a bit of a slow phase, and maybe over the next 1 or 2 quarters we would see the bottoming out taking place, assuming that the US economy starts again performing once the interest rates there starts helping the economy out there. So I think overall, to me, I think the sector generates decent cash flows. They give out good dividend, which leads to a good dividend payout ratio in the hands of the investors. So that is one good aspect. The sector actually tends to generate good ROC, which is a good thing for the long term. Just that the growth trend in the current environment is a bit slow, and we would like to maybe watch for early signals as to when these trends are improving. Having said that, I think the new area of artificial intelligence or generative AI, as they call it, those will also start providing opportunities, what it looks like, and most of the companies are preparing themselves for that. So I think from that perspective, we have a good long-term orientation for the sector, and maybe mid caps, given their higher growth trends, they justify their place today in our portfolios. But we are open to look at even the large caps. At a certain point we would be at maybe reasonable valuations. We are open to look at the large cap IT as well.
All right, one quick question really, as we end this conversation. Vinit, in the run up to the general elections, which are the themes within the mid cap space that you would be looking at? You mentioned that you would look at good businesses, right? Which pockets offer value at the current juncture, at least till the general elections?
So I think as of now, not really from the general elections perspective, but broadly considering the current context and what the landscape I have laid out, I believe that to some extent there is merit in being slightly more defensively placed. So we are overweight on segments like healthcare, within materials, we are looking at segments which would benefit from this whole real estate outlook improving and good pre-sales numbers being announced by the real estate companies. I think the benefit of that should now flow to the building materials as a category. As I mentioned, we have a decent positioning in the mid-cap IT space. The other area to look for is broadly the engineering and industrial companies, because I think those are going to be the beneficiaries of the government capex, which I'm assuming that post-election also that momentum sustains, and that is where we would like to keep our exposures. The last bit is consumption trends have been slowing at the moment, and that's an area which has seen consolidation both on the discretionary and the non-discretionary side. And as I said, I think it is very important that what we saw in the overall investment and capex momentum actually needs to flow into consumption at some point in time. And I think those segments should gradually be looked at. Maybe after 2 or 3 quarters, the momentum should begin there as well. And that is something which we are watching that space, and maybe gradually we would like to accumulate some good businesses within those space as well.
All right, that's the view then. Vinit, Sambre, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. Look forward to touching base with you post the interim budget as well to get in your views.
Thank you. Thank you so much.
Thanks a lot. Well, with that, let's go back to Prashant, who's been waiting quite patiently. Prashant, I want to get your thoughts on AU Small. A near 10% downtick coming in. Numbers came in over the weekend. In fact, there has been a sharp jump in provisions and the street clearly reacting to that. How are the charts looking? Do you think, it is headed lower from here? 641 is where it's at the current juncture.
So I think one thing that stands out is the selling which happened last week on Friday itself, wherein you clearly see that there were a very high volumes for the selling, which shows that the sellers were in control right till the closing on Thursday. And today there's a strong gap down. The strong support for this stock is the 625-630 zone, where it is currently headed to. So my suggestion would be those who are having positions and are stuck, clearly use a defined stop loss of 625 spot closing basis. If you see that the stock is closing or trading around 625 below it after 3 o'clock, 3:15 today in the afternoon, then straight exit from the position, because the weakness may increase and we may nosedive to levels around 580, 595. So 625 has to be your strict stop loss for any existing positions in the stock.
Right, that's the strategy on AU Small. But what about a Sawant? Numbers have been unenthusing. Profit down 16.5% on a quarter-on-quarter basis. Margins have also shrunk. Stock has been is reacting to numbers, but no big cut coming in there. But somebody having a position in Sawant. What should they really do? Should they average at current levels, or should they just kind of stay put?
So I think it's just a knee-jerk reaction. It's not if you compare the charts, AU Bank is a clear structural breakdown. This is just a knee-jerk reaction. One can add at current levels, which is around 19 or almost 2000. It's putting around 2000. You can add here, and today's low, which is the opening today, that's 1872. So plan your quantity according to this. Your stop loss has to be 1870, and I think the pullback can go up to 2200, which would be a good risk to reward. So current levels, one can add the stock for sure.
Right, add the stock at current levels for a Sawant. What about a Bajaj Finance? Numbers are coming out today. Ahead of the numbers, how should one position themselves in this stock? The stock is up 1% or thereabouts, above that 7100 mark now. Do you think it warrants taking positions today and perhaps holding on for a couple of more sessions?
So I think one thing that stands out here is it was clearly range bound in the 7200 to 7700 zone. But currently it's trading below that. It has broken that zone. So I would wait. I would not preempt the results and not get into a position. I would wait for the results. I would wait for the price to make a statement tomorrow. What the statement has to be is the stock has to trade again above 7300. If it trades above 7300, you can go along with stop losses at 7200 and look out for levels around 7450, 7500. But as long as you don't trade above 7300, I would say avoid.
All right, that's the view. Another stock to watch out for is ITC. Numbers are due. Profit and revenue may see single-digit growth. Of course, we know that rural demand has been a concern for most of these FMCG firms. But for ITC in particular, hotels and FMCG segment may do well, and cigarette business may also see a 3% kind of a volume growth on a high base. Stock is, among the losers on the Nifty. Here on, how is an ITC looking vis-a-vis HUL on the charts?
So I think if you happen to look at the last year's budget day candle for ITC, it made a very strong low. On from there, it started bouncing for the next 3-4 months. So I would wait for the budget day and see the reaction of the stock. A major support happens to be 440. So as long as it holds, one can keep adding, and a breakout can be expected above the 465 zone. So in the next 2-3 days, expecting the budget, I think 440. 465. These are the two levels to watch on the upside and downside respectively.
Right, that's the view on ITC. But macro tech, came out with numbers. Numbers are fairly good, but the stock is under pressure today. In fact, even over the last 5 sessions, it has lost somewhere around 7%. At a time when realty stocks have been in favor, how should one really approach a macro tech?
So I think one concept which we very clearly follow in terms of technicals is that price and time eventually catch up. If you see the run up which the stock had prior to the results, it was very strong, and the stock almost moved from around 800 odd levels to 1100, 1200 in no time. So I think this kind of a correction was expected, but one can add at current levels. I think you're quoting around 1038. So you can keep stop losses in the region of 1990 and go long. And I'm expecting a pullback up to the zones of 1180. So it's a good risk reward. And above 1180, the stock may also show levels around 1220. So I think the current opportunity can be used to add longs in Lodha.
All right, use this dip to add longs when it comes to a macro tech. But, just one last question, Prashant. As we step into the interim budget, how would you really advise investors to position themselves? It promises to be a volatile week, right? Lots of numbers to watch out for. We'll also have the Fed decision coming in. So lots of cues. It's a news heavy week, right? So how should one really position themselves and to ensure that they are, largely unscathed by the volatility?
So I think considering that it's an interim budget, I'm not expecting major news flow. But overall, since it's a budget, it's a big day for the Indian markets. I would say do not keep heavy leverage positions at all. Wait for the event to be over and start looking stock specific strategies from the next day, that is 2nd of Feb. So 1st Feb, budget and expiry together. I think the best way is stay out, wait for the event to be over, and then re-enter. As far as your portfolio is concerned, I don't see any major hiccups. So you can continue to hold the mid and small caps, but hold them with strict stop losses. Your stop losses have to be the lows made in the last week. And that simple strategy, you can stay in the budget week. As I said, once again, repeating the same thing, avoid leverage positions in FNO.
All right, avoid leverage positions in FNO as we step into the big event. With that, Prashant, thanks a lot for taking out time and joining in and sharing your thoughts and insights with us this morning. Well, with that, we've come to the end of this edition of Opening Bell. Of course, if you have any comments or thoughts, please leave them in the comment section below. And just on a programming note, don't forget to tune in for a special management interview with the MD and CEO of JSW Steel. Post their Q3 numbers. They will be talking about their strong India operations and future expansion and acquisition plans as well. So don't miss this special interview that is coming in at 10 a.m. Tune in for that.